All right. Hello, whoever this goes to. This is Gil and Evan just decided to do a debrief on the market today. It is 8 o'clock in the evening, Eastern Time, March 12th, 2020. Evan was just we were talking about mortgage rates and everything that happened in the markets today and what impact that can have for, I guess, real estate in particular, but just in general, talking about how the markets are reacting to the news of late. So I'm going to hand it over to Evan to school us. Go for it, man.
Good evening, or not such a pleasant evening, I should say. Gil, can you see my screen?
Yeah.
Okay. See my handsome mug? You can see it?
Yep.
Okay. As I said, good evening. This is a little bit of a kind of postmortem on one of the worst days since 2009 as far as stocks go. Oddly enough, as far as interest rates go too, which is odd. Again, my name is Evan Beach. I'm with Equity Prime Mortgage Professional. That's my handsome mug there. I'll get that out of the way for you. Basically what I wanted to kind of go over here is we saw a historic swing in the market for a multitude of reasons, and quite honestly, none of it makes sense. And you're going to hear me use a word frequently, and that's volatile. Basically, what this graph is showing here is the mortgage-backed securities, and this is over a 6-month period. And I'm going to drill into this and basically go just into the quarter here. So what this is basically is red is negative, green is positive. And what that means is positive is lower interest rates. So mortgage-backed securities, as this goes up, mortgage-backed securities are going up, rates are going down. So again, green is positive. So what you'll see here is this is the end of last year, 20th, 23rd, Christmas Eve, where we were really in kind of a flat pattern here. As we hit the new year here, rates started to go lower. Again, leveling off a little bit, going lower. And we started to see a good pattern going lower here towards, again, end of January. Kind of really leveled off in the beginning of February. And as we hit towards the end of February is when we really started seeing rates going down at a really good clip here. So you'll see, 20th, 24th, and going down up until basically the last week here. We've seen, March 3rd, and then going into basically which was really all-time lows as far as interest rates go, which was Monday morning, March 9th. And you'll see this here. So we were seeing, to put this into context, what this meant was basically your 30-year mortgage with good credit and, again, the proper LTV was down in the very, very low threes, sometimes 3.0 even. Took a few locks that were 3.0, 3 and 8, somewhere in that vicinity, which is historically fantastic. I mean, that's ridiculous for a 30-year fixed mortgage. But then what happened was basically in a matter of 2.5, 3 hours, we dropped historically. And you'll see this here, this red. So that since Monday, say probably about noon on Monday, we've done nothing but dropped historically. And I say historically because I'll pull this back for you here. Basically to, let's see what the 2-year looks like. You can see this plunge here is like nothing we've ever seen before. I mean, this is so dramatic, it's ridiculous. And again, to go back here, this is the end of 2018 where we were seeing rates, scrape 5%. A lot of rates were at 4.75, 4.875. A few were at 5.25. That was that, rate vicinity in that time frame. And as we moved along here, rates have gotten better. And again, to drill into what we're looking at here recently, it's just absolutely staggering. So what this means to interest rates basically is that we've lost from Monday morning until as we sit here this evening, again, March 12th at 8 p.m., we lost 3/4 of a point in a matter of basically 2.5 days, which is unheard of. It's almost impossible to wrap your head around. And the other thing that's really hard to understand is the fact that the stock market tanked completely. And we're seeing the stocks as low as they've ever been since 2008. So again, to bring this point home, this is basically these are text alerts that we get from mortgage-backed securities. So this is all throughout the day. I'll get these to see where rates are going. And again, this is Monday, 9 a.m. So this is what we woke up to Monday, 9 a.m. Again, plus is very good. And plus 86 basis points is called is insanity. I mean, we'll normally see swings. So for instance, like this stuff here, these are, anywhere from probably 10 to 15, 20. This may be 30 basis points, give or take. And Monday morning we woke up, and again, because the 10-year Treasury was underneath 0.5% as of Sunday night. So now we're seeing historically low interest rates. But, big but, what happened was literally in a matter of 3 hours, look what goes on here. We went from 86, plus 86 to plus 23. Then we get down towards 2 o'clock, and 2 o'clock, the bottom fell out. And you'll see from 2 o'clock on, we went from 86 in the morning and we finished the day flat. We lost 83 basis points in a matter of basically from 9 a.m. till close, which was ridiculous. And
that gap at the open on Monday that we were talking about on the Monday morning meeting, that was because of the stimulus that was on Sunday night, and then the market ate it all up by close.
Yep, everybody was scared to death of the 10-year, and rightfully so. The 10-year is underneath 0.5 point, which is historically low. It's never been that low. It got down to 0.3 something. So that was the spark for these historic low interest rates. So, but here's the crazy thing, and again, you'll see this here. Again, this is Monday. This is Monday, Tuesday, Wednesday, today. So this is Monday. We lost 83 basis points in a matter of a day. Then this is Tuesday. We woke up pretty flat. Again, started to drop Tuesday, minus 25 by noon, minus 63 by 2, and kept losing ground the whole day. Ended up minus 84 on Tuesday. So then what happened is yesterday seemed like we were going the other way. We're like, all right, great. We're going to go back the other way. Gained 22 basis points at the start, by 11, down and down the whole day. Ended up losing 64 basis points on the day yesterday. So you see a pattern here. This is how we're dropping. And then the cherry on top was today. Again, opened up with a little flicker of hope. By noon, completely crushed. And this is the interesting part here. And I'm going to bring this article in because this is really kind of fascinating how this all shook out. At 1 o'clock, 1:15, the Fed announced that it's going to launch a series of massive cash injections. So this was a huge step in potentially the right direction for mortgages and for stocks, basically. And again, they're going to announce they're going to put more than 1.5 trillion pumped into the banking system, into the Treasury market, to help out the bottom falling out of the stock market. So mortgages took that as a positive, and we gained, again, we're minus 67 at noon. By 2 o'clock, again, this got released. You'll see here, it got released at 1:30, 1:15. Gained roughly 60 basis points in a matter of an hour. So see that swing. And then this is the craziest part. From 2 o'clock to 5 p.m. in little less than 3 hours, we lost 97 basis points, which is the biggest drop of them all. And that's what you'll see here, going in this massive, massive drop. So as we close today, mortgages got absolutely crushed over the last 3 days, basically. So it has not been a fun time. So a lot of people that were, floating, or people that were purchasing trying to purchase and shopping at homes, or people that we had a huge rash of refi applications in the last week. Basically, we couldn't take applications fast enough. And it's a good analogy is, there's depending upon where you're at in the country, but 7-Eleven, Wawa, we're giving out free coffee, and there's 1,000 people in line, and they basically were able to give coffee out to 40 people, and they ran out of coffee. And that's exactly kind of the analogy for what happened with mortgage rates. I was able to take a handful of locks of refis and even of purchases and showed a ton of benefit. And then we're back to basically, as you can see here, we're back to more or less close to where we were, more or less at the beginning of the year, really, from where we're at today. So it's, mortgage rates are back to that, basically that 4% threshold, which is unheard of. We lost very near close to a point in interest rates in a matter of 3 to 4 days. I mean, realistically, 3/4 to close to a point in a matter of 3 days. I mean, it's just that nothing like this has ever happened. And it's such a paradox because of the fact that the economy fell to garbage and stock markets closed historically low. So that's normally when you see stock markets slide like that, stock markets lost 25 points in a day, mortgage rates should have followed suit and at the very least held where we were closer to the end of last week, but that didn't happen. So no one has any answers. If anybody has any answers, they probably don't know what they're talking about.
Right. That's that divergence from the normal, the divergence from the normal correlation is is the unprecedented part. In addition to the spread and these intraday drops, correct?
Yeah, I mean, the fact that, and again, it's just the proof's in the pudding here. I mean, look at the charts. It's nothing that you could even imagine.
Right.
These are 30 basis point swings here. So put that in context. I mean, look at this. This is 90 basis points right here today.
Right. It's
That's 30. So literally you could fit that 3 times in there. So that's the staggering part of it. And again, you can blow this up and go back as far as you want to go back, and you don't see anything remotely like this. Right. I mean, look at that. That's ridiculous. I mean, that's a matter of 4 days. So it's crazy. I mean,
perspective though, it's still as crazy as that is, it's still
correct.
General historically.
Yeah, absolutely. And that's the silver lining is that, it's such a completely rocky market. And again, the volatile is the word of the day and word of the week, really. But yeah, I mean, historically speaking, I mean, go back even to this 2-year pattern here, even if we were where we're at, at the end of last year, beginning of this year, we're still in a great pattern here. I mean, 30-year fixed that are still, around that 4% threshold is fantastic.
Right.
So, again, people don't need to panic and freak out. And same thing, I'll let you elaborate on the stock portion of it, but people to freak out on stocks unless you're retiring in the next, 6 months. I mean, put your blinders on and don't worry about it, because now's not the time that you're going to sell everything off with how the market is. And everything's completely on a different stratosphere right now. So the new normal is that there is no normal. That's basically where we're at. So you got to be in a position when the moral of the story is if you're in a position to lock a rate and you're purchasing or you're refining and the numbers make sense and you're happy with where your rate is and your monthly payment and basically the terms of the mortgage, lock it and set it, forget it, and don't turn on CNBC.
Right. Keep it in context of the grand scheme of thing. And just to touch on the stocks.
Correct.
If we look at, this is all time, whatever max, this is the 90s. This is the 2000 tech bubble around this window. This is March 2002, I guess. This is Lehman Brothers zone and the bottom out the following year. And then this is the insane bull run that we've had in the stock market as of late. And you can just start to see, just for context, where we're at when they talk about a crash here. The intraday like today was, I saw a headline, it was like worst day since Black Friday or Black Monday in 87. Um, and if you zoom in a bit, if you look at like a 1 year chart, we're erasing all the gains from the last year or two in the last week or two or so. And then it looks, whoops, I'm doing this live here too, but it looks really dramatic in the shorter term, but in the grand, you got to keep it in perspective of the grand scheme of things. But then if you do look on a 5-day chart, this is where I think this was Friday, and then we gapped down like 8% on Monday, 7 or 8% at the open, and then it was rocky all week. I guess that's Tuesday and then Wednesday, and then we gapped down again today. Both of these days triggered the breakers that like shut the market down for 15 minutes. And if you look on intraday, you can see that. And then this is this stimulus plan from the Fed that you pulled up. If you look one day, this is like the market reaction to it. Gap down again. I think this was like, they're claiming this was like the travel ban or whatever, sparked that. So we had like a large gap down, tried to rally throughout the day, then it faltered. This is what, 12:45 p.m. If you look at your note or whatever, that's when that announcement came out. Market rallied, but still didn't give up all the gains from the gap. And then the thing that's sort of telling to me about what they think about this is like, it plummets through the rest of the day, and then right before the close, if you look at the volume of shares throughout the day, this is when they close it down in the morning at the open for 15 minutes or whatever. But then at the end of the day, there's a huge spike in volume to kind of like pummel to the close or whatever. This is a $1.5 billion injection in the economy. I'm not an expert at that kind of stuff, but I know that 1.5 trillion, correct, Evan?
Yep.
Yeah, and I forget what Dodd-Frank and all those things were back in '08, but they were like 50 billion at a clip, not 500 billion at a clip, or like 80 billion or something like that. I'll have to check the history on that. But anyways, unprecedented like stimulus type plan. It seemed a little haphazard from the layman's perspective. And the thing that is, I heard people talking about today is like all the risk in this coronavirus stuff is like not just isolated in one industry, like mortgage-backed securities back in '08. It's which was all super leveraged and sort of all paper risk or whatever. This is like into the workforce, and people don't really know what's going on. So the uncertainty, I think, is where the market's not really liking all this. But again, in the grand scheme of things, like it looks super scary. If you look at it at an intraday thing, like it is a historic day, and we have erased gains from the last 2 years or so by now. I don't think it's the end of it. Not that I'm a day trader or whatever or stock expert, but it is historic. But in the grand scheme of things, it is. This is still the 10-year chart if you look at it, and it's good to keep all that in perspective. So I don't know. It was just I knew it was a short day on Monday, and then it kind of happened again today. So I figured we talked about doing this on Monday, but we forced the issue in the evening now. So I don't know.
I think it makes more sense to do it now after this craziness. So I mean, it's just a matter of where do we go from here. Everybody's got different ideas, and I think nobody has a crystal ball. Nobody knows what's going on. So it's just a matter of, keeping an eye on it and see what happens.
Yeah, my take on it is it's not time to speculate, but it's also not a time to freak out. Like there will be ramifications of it. And if I've got this pulled up, Ray Dalio's thing, he's got this article, Paradigm Shifts, that I've been recommending forever. He wrote this in July of last year, July 17th. And he's got an article about coronavirus specifically that's more recent, that's sort of like this thing, there's the market reaction to it, and it might, it looks like it could be more likely to tip the economy into some sort of change, for a longer period of time. He talks about long-term death cycles and things like that. So if you haven't read this thing, I'd highly recommend it, and following his commentary and things like that. But yeah, I don't know. I'm going to shut up because we're a dumb Ray Dalio's thing is I'm a dumb shit, and that's my favorite line to steal from him. So I just wanted to debrief with you, talk about the mortgage stuff, and then go from there, I guess. So thanks for your time, Evan. You got anything to add? Evan?
Oh yeah, you broke up.
I was just saying, you got anything
Sorry,
to
what'd you say?
close or whatever?
No, man, I think that was it. I was kind of hit everything up to speed of what's happening. So, your guess is as good as mine. What'll happen when we wake up tomorrow, and just gotta deal with it, man. Just ride the wave here. See what happens.
I put this on. Who's on Instagram here that's got a question? What do you got? You got nothing. We got silence. We got some viewers. All right. I'm gonna shut this off. My battery's about to die. I'll talk to you guys later. All right, Evan, you're the man.
All right. Sayonara.
See you soon.